What's going on, guys? Mike here, and welcome back to the channel. Today we're going to be kind of going in a few different directions. We're going to be reviewing kind of some changes, or just mentioning some changes that I've made in 2023. We're also going to be talking about what I'm kind of thinking or planning for 2024. We're also going to be looking at the individual accounts to see how they're constructed and just kind of give a quick recap for anyone that's new here as to why they're constructed the way they are. We're also going to be looking at those accounts on how they performed this year and to see which one did the best, as well as pull it all together and see how it performed overall. So, and just as a recap, or just as a reminder, we have a LIRA account that's held within Questrade, and then we have an RRSP and a TFSA that is held within Wealthsimple. So if that interests you, stay tuned and we'll get right to it here. So you'll see here on my screen, I'm just kind of sharing my passive login. This is actually new to me. I just started using this. I thought this was maybe a good way to kind of pull all the accounts together now that I am kind of operating in two different brokerages. And just as a reminder as to why I started using Questrade was because Wealthsimple doesn't allow self-directed on Wealthsimple, so on a LIRA account. So that's the primary reason. Otherwise, I still quite love Wealthsimple. It's my primary go-to. But since I had to kind of diversify into two different brokerages, I felt passive was a really good way to just kind of bring it all together. So you can see here, I have it highlighted on my screen. My total holdings at the end of this year, 2023, is at 61,000 and change. Now, if you're not new to this channel, if you're a subscriber, you'll remember that a few videos ago I was in and around that 28,000, or the last time I kind of did this portfolio update. So obviously some bigger changes has happened, right? So I do have a video specifically on when I moved my LIRA account from RBC to Questrade, and of course it went over what I had purchased at that time. Also, if you're new to the channel, you won't know this, but I do have another RBC RSP account that is actually through a work plan, and every time that account hits $5,000, I sweep that, or that's what I call it. I sweep the account of 5,000 to Wealthsimple in my RSP so I can self-direct it. And the reason why I wait till it's 5,000 is because then Wealthsimple pays for the transfer fees. So that also happened in 2023. So there's a number of factors that kind of increased my holdings to 61,000. It's not that I am a professional investor and I made a ton of money as much as I would like to, but yeah, so obviously we're at the 61,000. And so we're just going to kind of quickly go over each individual account and just kind of remind everyone as to what we're holding and why I'm holding it, and kind of go into there. So just as before I swap to the LIRA, just take note of the different values that we have here. We have 22,000 in the LIRA. We have 9,000 in, or 9,600 in the TFSA, and just shy of 30,000 in the RSP. So moving over to the Questrade account, you'll see here it's very simple. I just hold two holdings, which is XEQT and ZAG, which is my bond allocation. So if you guys didn't watch the video, which is here, I did want to kind of go the simple route, because if you guys remember, Questrade, you have to pay fees on every transaction you do. Now, of course, the fees, or you don't actually pay any fees, I guess, when you're purchasing an ETF, but you do pay a fee to sell an ETF. So again, I wanted to keep the transactions light because I'm not necessarily thinking for right now. I'm also thinking for retirement when I need to go and sell these assets. I kind of want to avoid the number of transactions I have to do, right? So I think Questrade has a minimum transaction fee of like $4 or something. So again, instead of me having like say 7 ETFs that basically just compile or just create XEQT, I figured, well, let's just have one equity holding of XEQT so I can have one transaction when I need to sell it and make it simple, right? And again, since the LIRA I can't contribute to, I can't really do much with it. I kind of wanted to make it just more of a set and forget, right? So whenever the dividends come in from the bond fund as well as XEQT, then I will make the minor adjustments for that. But outside of that, there's not a whole lot of activity here because again, I can't really do anything with it. If you do remember, I did choose to go kind of a 90-10 construction on this particular portfolio or this account. Again, I was kind of interested in when I was kind of building this LIRA portfolio. I was kind of looking into, how bonds have performed over the past, history as well as equities. And there has been certain times within history where, an 80-20 portfolio actually did better over, say, a 10-year span than compared to like 100% equities. Just because, of course, when you have 100%, your volatility can be higher, right? You have higher ups, but you also have higher downs. And sometimes being leveled out, like say in an 80-20, it can help soften the lows, and then you don't have to have as much of a recovery to actually come out on top, right? So in this particular case, I chose a 90-10. I think I'm going to stick at a 90-10 for quite some time. I'm only 33 years old here, so I'm still quite young, and I do definitely want to have the majority of an equity exposure. So this is kind of what I chose. And again, if you don't remember, I do kind of have different structures per account, so we can kind of see which one is going to perform better over the long run. So, like I said, that is the LIRA account in recap. Again, not much changes to this account due to it being a LIRA. So the next one being the TFSA. This one's got a little bit more kind of going on. Still not a whole lot, but primary holding, obviously, XEQT across the board on all accounts. So you can see here 262 shares of XEQT within my TFSA, and that works out to be somewhere between 70 to 75%. Now, at the start of the year, I actually had this holding at a target of 70%, and I just recently moved it to 75 because I ended up actually selling a position in here, and I'll get to that right away. But I did increase the target of XEQT in my TFSA to 75%. The next holding here being TD Canada Trust. Now, obviously, it's actually a pretty small weighting. It's only 5.7 shares. If you do remember, in my construction of any account that I'm going to have, any single equity that I have, I'm not going to have anything more than 5%, right? So 400 or 5.78 shares of TD is roughly about 5% of my TFSA holding. And that's going to be, again, across the board for any individual holdings. So again, you'll see I have a few REITs. Again, they're not going to be any more than 5%. Now, that's typically just standard practice. Once you kind of go over that 5%, you're just taking on a lot of additional risk that I don't really feel is necessarily worth it, right? I don't want to say like be 100% into a single equity, or even, maybe 100 is a little aggressive, but let's say 40%. And it drops significantly. As you'll see here in a little bit further of this video, Plaza REIT is down like overall, I think 12% this year. And again, since I only have 5% of my overall TFSA worth in Plaza REIT, it didn't really affect me all that much. So it's just something to always kind of remember. But now that we're on the topic of Plaza REIT, obviously I do like having the REIT exposure. And obviously REITs in 2023 have not done well. Again, I will be kind of getting into the overall of everything. And again, REITs across the board have not been great. But always remember that, I didn't sell this because, I've gone down 12% in Plaza REIT. REITs in general were all going down. So it doesn't necessarily say that there's a problem within this particular asset of mine. It's just that the actual sector itself is going down due to the interest rates, right? So the interest rates are going up, they're devaluating their properties because of how expensive debt is now today. So it's just lowering the overall value of all of the assets within the real estate REIT. So again, there's not really a problem, it's just the fact that the entire sector is just kind of going down. Now, if say all the REITs were going up and then Plaza REIT was going down, well, that would require some sort of due diligence to figure out why and whether or not it's worth keeping and riding out the volatility. But in this case, I haven't made any changes to any of my REITs. So again, Smart Centers, another real estate REIT of mine, again being 5%. Again, it is in the negatives. I think this one performed the best out of all the REITs in my holdings, but we'll get to that here in a little bit. Enbridge, obviously another one that's gone down. So all my individual holdings have all gone down, whereas XEQT has been in the positives. So my core holding has helped. But again, due to natural gas and oil, Enbridge is also down from its all-time highs. TELUS and any of those telecom giants, they are very debted, right? So high interest rates, they're going to go down because their debt is costing them so much more money compared to what they were, say, in 2022, 2021, etc. I've continued to buy. I've stuck to my plan. I keep it at my 5% target. And I'm expecting in the 2024 and 2025 for this to rebound. Or at least that's my magic 8 ball is telling me. So that is the TFSA. Just to kind of quickly recap those potential, or those targets, like I said, 5%, which I'm pretty accurate on, looks here. I'm just a little over on the TD Canada Trust. And my XEQT is 0.1 below its target now. I actually just made a purchase today because, again, I'm a bi-weekly investor and I transfer $210 bi-weekly into my TFSA, and I increase that by 15% each year in August. So another 15% will be added to that next year, 2024 August. So that's that for now. So that's the TFSA. So now going into my RSP, again, a little bit different. So again, but the core holding is exactly the same at XEQT. That is, again, like I said, my core across the board. So this one here, you're gonna see this guy here. Now this guy actually doesn't have a target, and if you're unfamiliar, so this is PSA. This is the high interest savings ETF, and if you're unaware of that, definitely check out my other video that explains this in further detail. But this is essentially a savings account in the stock market, and it's actually paid out, I think, pretty close to 5% for the year. And I kind of just considered this as kind of like a cash position, essentially, because instead of just cash sitting there and collecting nothing, I actually put $4,000 into PSA to at least collect 5% for the year. Now, I think in 2024 I am going to sell this, and we're going to get in a little bit more detail about that here shortly. But I do not think I'm going to keep this because, like I said, I kind of held back $4,000 when I moved the original total of my RSP from RBC. So that I could just kind of guarantee myself a portion or level out the volatility that we were kind of all experiencing, right? VDY, again, this is actually a favorite of mine. This one particularly is high in financials and energy, and it pays a nice monthly dividend of, I think it's somewhere between 4.5% and 5%. I might not be accurate on that, but it's in and around there. Again, I just kind of feel that if I'm going to have Canadian exposure, I do enjoy having the exposure to financials and to energy, just because that is our primary sectors. And if we're going to capitalize on good returns within Canada, I do feel it's going to come from those particular sectors. So the other thing I do like to focus on just slightly is dividends within the RSP. Now, I do not necessarily invest into dividend stocks for a dividend income. The reason why I like the dividend is because I don't contribute to my Wealthsimple RSP on a bi-weekly or a monthly basis. And I do like receiving that dividend so that I can level out my targets, right? So if I have something that is like skyrocketing and I have gone from my 15% target to 25%, with the dividends, I can start reinvesting that money into the other positions within my RSP to bring down that target, right? So that's the main reason why I do dividends within a few of my accounts. I do have an allocation to my bond fund. Now, this is the target on this. I think it's supposed to be 10%. I will look in that when I flip over the screen. I sometimes have issues keeping track of all the numbers, but it is kind of thrown off because I do have PSA. But I am kind of counting PSA and ZAG as kind of the same thing, even though they're not. When I do sell off PSA, it will restore my 10% target to ZAG in my RSP. And one last REIT that I have within my RSP, which is RioCan. Again, just kind of one of the top REITs within Canada. Again, hasn't performed well, but I just continue to stick to my targets on my contributions, and I do believe long term it's going to be completely fine. So I think RioCan is the best position in all of this because I think it was in 2021 they actually cut back their dividend payment. So they were actually in a really healthy position going into this higher interest rate environment because they didn't necessarily have all of their free cash flow being paid out to a dividend. They actually had leftovers to obviously pay down some of their debt. So again, overall, that all adds up to, before I go into the overall again, just to kind of review the targets, you're going to see here, like I said, the 86% is because I have PSA, right? I have PSA as a 0 target, but it's actually 13% of the overall fund. And again, ZAG is showing it's below. So yes, 10%, and it's at 8.7. So when I do sell off PSA, most likely in 2024, I will square this up to 10% and obviously bring everything where it should be. And again, when I sell off PSA, this will reach back up to the 70%, etc., etc. So like I said, in 2024, I do believe that things are going to kind of come down a little bit in a sense of interest rates, which is going to make PSA a lot less valuable to me, because right now if it's paying 5%, that's great. I feel like that's like an average return that I would be happy to have. But anything below that, I kind of want to start, putting it back into the bonds. I want to put it back into the equities, because long term, I'm going to make much more than 5% on those particular holdings. So that's kind of how I'm going to be playing it out. So again, on the dashboard, 61,000 and change for holdings. So going into the reporting, I'm just going to kind of show the individual performances here. So the Quest trade being pure XEQT and ZAG isn't going to show, I guess, a true year-to-date, because I did transfer it in May, which is obviously why you see this massive contribution here. So I did transfer, though, just over 20,000. And if you do remember, the Quest trade LIRA is actually at 22,000 now. So it's actually had a pretty good gain this year, actually, which is pretty nice. And it did come in, like I said, I didn't say it, but 7.33% time-weighted return. And if you don't know what that means, the time-weighted, I'm going to get into it a little bit here in this video. I know this is kind of a long one, and I hope it's okay. Anyways, 7.33% year-to-date on a time-weighted calculation. So moving over to the RSP, we have that guy coming in at, just give it a few seconds here. Likes to take its time when you're on camera, at 11.02%. Now again, so this one looks like it performed really good compared to the LIRA, but I'm not sure it's a true comparison, and we're really going to have to wait until 2024 to kind of start seeing the different portfolios perform on a month-to-month and a year basis, right? So we're gonna have to wait and see on this. But yeah, the actual LIRA or the RSP itself, 11.02% this year, which is awesome, as well as my TFSA coming in at And this one did less than the RSP, but it's because of my real estate exposure. Actually, no, I'm wrong. 12.26% year to date on the TFSA, which is awesome, actually. So pulling that all together, let's just kind of quickly put these all in here. And we'll actually look at like the total dividends and the total growth for the year as well here. So the total came in here as 11.7% year to date on all three accounts. So that's a total of $5,138 of investment growth this year, which is a massive thumbs up. I averaged about $101 per month on dividends, and of course June being the biggest month, where I got $331 between all three accounts, and the dividend income totaling for the year $1,203. So I'm pretty happy with that. I can't complain with any of that, especially I didn't really anticipate 2023 actually being a really good positive year. So that's awesome. So I'm just going to quickly highlight, if you're new to this channel, you may not actually, you won't know this, but I use an RBC fund as kind of a personal benchmark, just because that's what I used to be in before I decided to go DIY. And I wanted to use it as a benchmark to just kind of validate that, hey, I made a good choice, right? So I'm going to just change this as a year to date to January 1st, but I'm going to cap it off at November 30th. And the reason why I'm doing that is because the mutual funds, they don't typically update. They update like once a month on their website. So I'm just going to quickly get what my year to date was on November 30th, because that's when the last time this fund was updated. And you can see here, November 30th, I was at 9.09% year to date. So looking at the RBC fund, you'll see here, which is RBF 460. This is the fund that actually my work group goes into. It scored here a 7.1% year to date as of November 30th. And I just want to kind of highlight that again. Now, I do obviously a little bit of massaging or playing within my portfolios, but my goal in all this really was to, when I started doing DIY, was to basically mimic, what typical professionals would be doing, index funds or whichever you want to call it, but save on the fee. So you can see here the fee being 1.95%. So effectively, my goal this year would have been to score roughly 2% more than what this fund has gotten, which I have effectively achieved, right? So 7.1, you add the fees, and I got 9.09, which makes me very happy. I really can't complain about that. So, check mark on a goal achieved. Now, will that happen next year? I don't actually know. I kind of feel like maybe it will beat me next year, because if interest rates start coming down, this particular RBF 460 fund has a higher bond allocation that I'm actually doing on my DIY side. So if interest rates start coming down and if bond funds start skyrocketing in capital appreciation, there's a chance that it could beat me next year. But again, you can't take just a single year of performance and say, oh yeah, I'm a good investor or whichever. That's really not the case. But I'm going as long term, so we'll see, right? There's probably going to be a few years where it does beat me, but I'm in this for the long term, and we'll see how it plays out. One thing I do just want to highlight here though as well is that throughout the channel, you're going to probably see maybe different percentages. And the reason why I'm just going to quickly bring this up is because year to date, like I was saying, I think it was all-time, between all accounts, is 11.7%. Let me just refresh this here. Year to date, 11.7%. So now if I go over to my Excel sheet where I use for tracking, it actually tracks the percentages differently, and it's in a money weighted return, which you'll see here my year to date is actually 8.7%. So if you guys are unfamiliar of the differences, basically a time weighted is a good way of measurement to see how your portfolio performed over a year or a time frame per se, right? So essentially, like for example, these guys here, they are displaying it in a time-weighted return because they basically take what the fund was worth at the start of the year, and then they take, as of November 30th, what the fund is worth at that very moment. And you do the calculation, and in this circumstance, it was 7.1%. What it doesn't take into account is that when I'm, say, investing in it, there's certain times where I'm buying and selling, right? So if I'm buying at a high all the time, then my return is probably not going to be 7.1%. But if I'm buying at lows and highs and there's a mixture, and I'm selling at highs and I'm buying at lows, then my money weighted return will actually be different. So I'm going to put on the screen here, because I do have my bi-weekly contributions through my work that go into this fund, and you'll see my year to date on it is 4.85%, and that would be a money weighted return. So I just wanted to show you guys that even though I'm passive, it says I've made 11.7%. That's what the portfolio has performed at. Now, based on my weekly contributions and when I'm buying and when I'm selling and the massaging that I do throughout the year, I've actually got a 8.7% year-to-date money-weighted return. I hope that makes sense, but I want to make sure it's transparent because, some people on YouTube are just showing like time-weighted, but that's not actually what they're making. So the 8.7% is actually what's in my pocket today. So I just, like I said, wanted to highlight the key differences between time-weighted and money-weighted. So that everyone is aware. But just to kind of quickly highlight the different categories and how well they did this year, I want to quickly show my best performing year to date was Power Corporation, ticker symbol POW, and it scored 16.4% overall for the year for me. And I did sell it. I actually sold it, so I actually capitalized on that 16.4%. And if you remember when I was going over the TFSA, I said that I increased my XEQT allocation to 75%. That's why I minused out this 5% single holding, and I allocated it now to XEQT. The reason why is because in 2024, I could see myself kind of shrinking down on the single equities that I have because I've realized that I can't outperform XEQT. So you can see out of all of my individual holdings, the REITs here, as well as Enbridge, the TD, and POW, I didn't outperform just a single XEQT, right? So when you put them all together. So I think long term, it's best for me to start investing primarily into ETFs. So in 2024, I could see myself focusing more on getting into more just an ETF based. And so when it comes to my REITs, I do have a particular real estate REIT that I am going to be looking into. I didn't have it pulled up here, but it's this guy right here. I'm going to do a specific video on this particular ETF, but I do believe that this is the one I'm going to move into. And kind of like I said, kind of start trimming back on the individual REITs that I have and allow the professionals to allocate the funds to the REITs that make sense at the time. So that's kind of what I'm planning. And like I said, I've already sold off one of my individual holdings just because it did so well this year, which was, like I said, Power Corporation, and then I moved those funds into XEQT. So I hope this was informative. This is the longest video I think I've ever made, and like I said, if you guys liked it, definitely subscribe, like the video if you liked it, and I will definitely and hopefully see you next time. See you guys.